You got hit with ransomware. Systems are down. Your incident response team is on site. The attacker is demanding $2 million. Your CFO opens the file folder where the cyber insurance policy lives and reads the figure out loud, $15 million in coverage. You exhale. This is what you paid the premium for. Then the insurer's claims adjuster calls. They have questions, a lot of them. And by the time they're done asking, the coverage you counted on is significantly smaller than the number on that policy. This happens more often than the industry will admit. The cyber insurance market has grown from almost nothing in 2010 to over $15 billion in annual premiums today. It expanded rapidly through the late 2010s as ransomware attacks increased and companies scrambled for financial protection. Then the claims started coming in. Lockbit, Revel, Conti, each wave of ransomware generated billions in losses. Insurers who had priced policies based on historical data found themselves paying out far more than they'd modeled. The response was predictable. Premiums increased by over 100% in 2 years, coverage limits were reduced, and the underwriting questions got much harder. A standard cyber insurance policy covers several buckets. First-party costs are what you pay yourself. Incident response and forensics. Business interruption losses, while systems are down. Data recovery and restoration. Ransomware payments if you choose to pay. Notification costs to alert affected customers. Credit monitoring services. Third-party liability covers what others claim against you. Lawsuits from customers whose data was exposed. Regulatory fines and legal defense costs. Settlements. That's the general framework. The gap between that framework and actual claims payment is where the real story lives. The War Exclusion is the clause that generated the most controversy in recent years. Merck was hit by NotPetya in 2017. A Russian state deployed cyber weapon that caused $1.4 billion in losses. Merck's insurer denied the claim, citing a war exclusion in the policy, the same clause that excludes coverage if a physical war destroys your assets. The insurer argued NotPetya was an act of cyber warfare by the Russian government and therefore excluded. Merck sued. A New Jersey court ruled in Merck's favor in 2023, finding the exclusion applied only to kinetic warfare. But insurers immediately began updating policy language to explicitly address state-sponsored cyber attacks. Underwriting questionnaires are now the gatekeeping mechanism for cyber insurance. Before issuing a policy, insurers demand proof that you have specific controls in place. Multi-factor authentication on all remote access. Endpoint detection and response tools deployed. Regular backups tested and stored offline. Privileged access management for administrator accounts. Incident response plan documented and exercised. If you self-report that you have these controls and you don't, or if your controls are inadequate, the insurer can deny your claim on the basis of material misrepresentation. That's insurance language for, you lied on the application, so we're not paying. Business interruption coverage is frequently the largest financial exposure and also the most contested. Policies define business interruption loss as revenue you couldn't earn because your systems were down. The catch is the waiting period. Most policies have a deductible measured in time, not dollars. The first 8 to 72 hours of an outage are typically not covered. For a company running on thin margins, those first hours might represent millions in losses that come entirely out of pocket. Additionally, insurers require documentation connecting the downtime directly to the covered incident, not other factors. If your recovery was slower because your backups were outdated, that's a contributing factor your insurer will note. The most important thing you can do before buying cyber insurance is get a third-party security assessment. Not because insurers require it, though increasingly they do, but because it closes the gap between what you think your security posture is and what it actually is. Discovering that your MFA rollout missed your VP in access after you filed a claim is an expensive lesson. The assessment also gives you documentation. If a dispute arises about your security controls at the time of the incident, having a dated third-party attestation is the difference between a paid claim and a legal fight. Read the sublimits. A $15 million cyber policy may have a $2 million sublimit on ransomware payments, meaning even if the demand is $10 million, The policy caps ransomware reimbursement at $2 million. Social engineering sublimits are often even lower. Business email compromise, where an attacker impersonates an executive and convinces an employee to wire funds, is frequently covered at only a fraction of the main policy limit. Sublimits are buried in the policy schedule, not the summary page. Most buyers never read them before they need them. Incident response panel requirements add another layer of complexity. Many cyber policies require you to use the insurer's pre-approved panel of IR firms, legal counsel, and forensics vendors. If you hire your own outside team, even a more capable one, the costs may not be covered. Some policyholders have found that the insurer's panel firms are already overloaded during a major ransomware wave, creating delays. Know before the incident whether your preferred IR vendor is on the panel. If they aren't, negotiate panel inclusion at policy renewal, or understand that you're paying out of pocket if you call them first. Cyber insurance is not a replacement for security. Insurers understood this before most of their customers did, which is why the questionnaires got longer and the exclusions got broader. A policy buys you financial protection against losses you couldn't prevent despite good security. It does not buy you the right to skip controls. The companies that are getting the best coverage at the best rates are the ones that could demonstrate strong security before the policy was written. That's the model. Security first, insurance second. If you want to understand what happens when small businesses skip both, our video on why small businesses are the new target covers what attackers are actually going after and why.